Jake buys a whole life insurance policy. Marcus buys term life insurance and invests the difference. They both think they made the responsible choice. They're both wrong because one of them is paying for something he doesn't understand, and the other is trusting himself with a decision most people never actually follow through on. And when you run the real numbers over 30 years, the gap will make your stomach drop. Let's keep this fair. Jake and Marcus are both 30 years old. They both earn $60,000 a year. They're both married with one kid on the way, and they both just sat through the same conversation with an insurance agent who told them they need coverage. The only difference is what they walked out with. Jake buys a whole life policy with a $500,000 death benefit. His premium is $420 a month. The agent explains that part of that payment builds cash value, a savings component inside the policy that grows over time and that he can eventually borrow against. Permanent coverage, guaranteed payout, a savings account attached to a safety net. It sounds like the responsible, grown-up choice. Marcus buys a 30-year term life policy with the same $500,000 death benefit. His premium is $32 a month. He takes the difference, $388 a month, and sets up an automatic contribution into an index fund. No cash value, no guarantees, no agent calling him back next year to check in. Just a bill that expires in 3 decades and a brokerage account he manages himself. On day one, Jake has a policy with his name on it, a document that feels like an asset, and an agent who treats him like a client worth keeping. Marcus has a term policy that's basically a subscription and a robo-contribution he barely thinks about. Jake's mother-in-law asks about his coverage and nods approvingly when he says whole life. Marcus's father-in-law asks the same question and says, "Term life? That's it?" It's not close in terms of how it feels. For the first few years, Jake feels secure. He's paying more, but he's building something. His agent sends him an annual statement showing his cash value growing. Year 1, it's around $1,200. Year 3, maybe $4,800. It's real money sitting inside his policy, and he can see it on paper. He tells people he's got permanent coverage and a savings account built in. 2 birds, 1 payment. Marcus, meanwhile, logs into his brokerage account once a quarter. Year 1, his contributions have grown to about $4,700. Year 3, roughly $16,000. No agent, no annual statement in the mail, no phone call checking in. Just a number that moves around on a screen that he mostly ignores. Here's where it gets interesting. Let's look at what's actually happening inside Jake's premium. Whole life insurance bundles 2 things together, the death benefit and a savings component, and charges you for both, plus commissions, plus administrative fees. In the early years, the vast majority of Jake's $420 monthly payment goes toward those costs, not toward his cash value. Industry data shows that in year 1 alone, 50 to 90% of the premium can go to commissions and fees before a single dollar builds cash value. That's why his statement showed $1,200 in year 1 on payments totaling $5,040. Nobody explained that math at the kitchen table. Marcus's term policy has none of that complexity. $32 a month buys pure insurance, a death benefit, and nothing else. No cash value, no savings component, no fees eating into a hidden investment. The simplicity is the point. And the $388 he's not spending on insurance is going straight into an index fund with none of those layered costs attached. By year 10, Jake's cash value has grown to approximately $38,000. That sounds decent until you compare it to what he's paid in. Over 10 years, Jake has paid $50,400 in premiums. His cash value of $38,000 means he's effectively lost $12,400 relative to what he put in. And that's before accounting for the fact that if he wants to actually access that cash value, he has to take a loan against his own policy. And that loan accrues interest. It's not free money sitting there. It's collateral. Marcus, over the same 10 years, has contributed $46,560 into his index fund at $388 a month. At a 10% average annual return, his portfolio is sitting at approximately $67,000. He's paid $32 a month in pure insurance costs the entire time, protecting his family for pennies a day, and built more wealth than Jake did, without a single agent phone call. The whole life pitch is the number everyone hears in the sales meeting. Permanent coverage, cash value, tax-deferred growth, forced savings discipline. It's the number on the brochure, the number the agent circles on the whiteboard, the number your uncle brings up because his policy from 1994 is finally worth something. What nobody explains clearly is what's actually funding that cash value and what it costs to access it. Fees and commissions. Whole life policies typically carry commissions of 50 to 110% of the first year's premium, paid to the agent, built into your cost. That's not a one-time hit either. Ongoing administrative fees continue for the life of the policy, quietly reducing how much of your payment ever becomes cash value. Opportunity cost. Every dollar Jake pays above the cost of pure insurance is a dollar that isn't compounding in the market. The gap between his $420 premium and Marcus's $32 premium, $388 a month, is the real cost of whole life, not the sticker price, the foregone growth, surrender charges. If Jake decides in year 5 that whole life isn't for him and wants out, he doesn't just get his cash value back. Most policies impose surrender charges for the first 10 to 15 years, sometimes eating 100% of the cash value in year 1, tapering down slowly. Cancel early and you can walk away with nothing, or close to it, after years of payments. Loan complications? Borrowing against cash value sounds like free access to your own money. It isn't. The loan accrues interest, typically 5 to 8%, and if you don't repay it, that balance gets deducted from the death benefit your family eventually receives. You're not withdrawing your money. You're borrowing it from yourself at interest. Low internal returns. Even after decades, the cash value growth inside most whole life policies averages around 2 to 4% annually, well below what a diversified index fund has historically returned over the same time horizon. None of this shows up in the sales pitch, but it shows up eventually. By year 20, Jake has paid $100,800 in total premiums. His cash value has grown to roughly $145,000. It's real growth, finally starting to compound meaningfully, but it took 2 decades of overpayment to get there. His net position, cash value minus total premiums paid, is about positive $44,000. Not a disaster, but not what he pictured either. Marcus, over the same 20 years, has contributed $93,120 at $32 a month for insurance plus $388 a month invested. His index fund, growing at a 10% average annual return, is sitting at approximately $265,000. His net gain relative to what he put in is roughly $172,000, 4 times Jake's position, and he still has a $500,000 death benefit protecting his family the entire time through his term policy, which, by year 20, has 10 years left before it expires. This is where it matters that term life isn't permanent. If Marcus dies at 55, 1 year after his term expires, his family gets nothing from the policy. That's the trade-off. But by that point, Marcus's investment portfolio has grown large enough that he likely doesn't need the death benefit anymore. He's become self-insured. That's the actual strategy behind term life plus invest the difference. You're not skipping protection. You're building your own safety net faster than the insurance company builds one for you, and then you don't need theirs anymore. By year 30, Jake's whole life policy has a cash value of approximately $310,000 against $151,200 in total premiums paid. His net position is about positive $159,000, plus a permanent $500,000 death benefit that will pay out whenever he dies, no matter when that is. Marcus's term policy has expired. He paid a total of $11,520 in term premiums over 30 years and has zero coverage remaining. But his index fund, with 30 years of $388 monthly contributions at 10% average annual return, is sitting at approximately $876,000. If we look at his total net worth built through this strategy, contributions of $139,680 have become $876,000, a net gain of roughly $736,000. When you put the two side by side at year 30, Marcus has significantly more wealth, but no remaining death benefit. Jake has less wealth, but permanent guaranteed coverage for the rest of his life, whenever that ends. If I only showed you the downsides of whole life, I'd be doing exactly what every fee-only advisor on YouTube does. Whole life has real advantages that get dismissed too quickly. Guaranteed permanence matters if you have a dependent who will need lifelong financial support, a special needs child, for example, where the death benefit needs to exist no matter when you die, even at 90. Term life simply can't offer that. Forced discipline is real too. Most people who say they'll invest the difference don't. They spend it. A whole life policy's built-in structure means the money goes somewhere productive even for people who lack investing discipline. And the tax treatment on cash value growth is genuinely favorable, growing tax-deferred and accessible via loans without triggering a taxable event the way selling investments would. Whole life makes sense in specific situations. High net worth individuals using it for estate planning and tax strategy, business owners funding buy-sell agreements, people with lifelong dependents who need permanent coverage, and people who know themselves well enough to admit they will not consistently invest the difference on their own. Jake and Marcus both sat down with that agent thinking they were being responsible. Jake thought permanent coverage and forced savings was the safe adult choice. Marcus thought cheap protection and self-directed investing was the smart, efficient choice. Neither of them actually ran the full 30-year numbers before signing anything. The real trap isn't whole life, and it isn't term. The real trap is buying either one based on what an agent's commission structure incentivizes them to sell you without ever calculating what you're actually giving up. And if you're wondering what happens when you combine strategies, term life while young with a plan to build permanent coverage later through other assets, that's a completely different conversation. And the math might surprise you. But for now, the next time someone tells you insurance is an investment, ask them one question. What would this money have become if I'd just invested it myself? Because that's the only question that actually matters.